So it's there so people can get access to it. But welcome everybody. Thanks for coming to another one of our Lunch and Learn meetups. Today is going to be a great one. Lots of stuff to learn. 5 ways to form your business the right way. I mean, I sort of took a little of Brian's thing and made a little slight change, but he's going to go through his stuff. He's an awesome guy. Brian's is a lawyer. He's at Nolan and Hyman. We became friends through an online sort of luncheon meetup type thing, and we've been connecting. And he gives valuable information and really helpful stuff. So yeah, Brian, I'll let you take it away and fill in any gaps on things.
Great. Yeah. No. Can people see my screen?
Yeah, we see right now just like your Outlook meeting thing.
Oh, you don't see the PowerPoint?
No.
Oh.
Good thing you don't have anything bad.
Yeah, I was gonna say what's on there. Yeah, I don't know.
It's just my invite.
Does any Yeah, I don't know how to put this up to the forefront because I'm looking at my screen shows the presentation.
Let's see. Let me see if I can pull it up. It should tell you which screen, like screen 1 or 2 on there. Does it tell you that? Let me just share. If not, I can go in here and pull out the thing and you can tell me next slide. Do that. Let me see something. I just gotta pull it up here with all the people doing their stuff in the background here. Let me see, Amazon. Give me 1 second here. I'm looking at my Google Drive. Oh, here it is. There you go.
Oh, now you can see it? Okay.
Yeah, that's
okay.
It.
Perfect. Okay, so like Andrew said, I'm an attorney. I work with mostly startups and small businesses on anything from forming their business to raising money from investors, selling their business, and basically any commercial like contract stuff that comes up along the way. I'm not a litigator. I don't do the disputes, but basically any sort of agreements, corporate structural formation type of thing. That's what I spend my time doing. A lot of the issues that basically any young company or even a company that's been around for a little bit, they face is sort of when to kind of take the step of turning your business into something more formal, creating an entity, starting to just pay more attention to separating your assets, from your personal, funds and assets to, the assets that you use for your business. So, I just want to touch on some of the considerations along those lines. It's as I actually had a Shopify store, years ago. So I know that, the hardest thing to do is to divert resources away from, growing your business, whether it's marketing or development, all that stuff that's, how you grow. And so it can seem like a not an annoyance, but something that you just want to put off to actually create a company and structure your business as a corporation or an LLC. But, at some point you are going to have to do it. You should do it. And it's just part of not only making your business, more professional, but also protecting yourself and your personal assets from exposure. So just working off my slides, I think the first thing to talk about is, if you are a seller on Shopify, you have an e-commerce store on Amazon, and sales are picking up, and you want to think about forming an entity and start, consolidating your business assets into that entity. There's a few different ways to do it, and I'm just going to run through most common ones. So basically, a sole proprietorship basically means that you aren't actually doing anything officially to create a new entity. You may, have a DBA. You might actually have a name that you're using for your business, but you actually haven't taken any steps to form an entity. This is the easiest because there's no expenses associated with it. But you do have exposure if somebody were to sue you, say that you're infringing on their trademarks and you're stealing their IP, stealing their, images, products, then you could be in a situation where if they did pursue that, then your personal assets could be exposed. So you definitely want to prevent that. Partnership is basically just an agreement between people to be partners. Some states don't even require you to actually do anything with the state. You just would have some sort of partnership agreement. But the problem with the partnership is that the partners are still liable for the partnership's actions. I mean, there's ways to separate that, by creating one person who's a general partner, and more passive people that are involved are limited partners, so they have less liability. But for your purposes, you don't need to worry about, unless you're starting a law firm or a venture capital fund, you shouldn't have to worry too much about a partnership. But partnership's a word that people use obviously in a lot of different scenarios, just to imply like an agreement between people to work together. But as far as creating an actual entity that's a partnership, it's probably not the path that you're going to choose. The LLC, or limited liability company, is relatively new. And when I say that, I mean maybe people started using it more and more frequently, maybe 20 years ago or somewhere along those lines. So a limited liability company is an entity you form with the state. It is technically a partnership for tax purposes, meaning that the income that you get to your store is not taxed at the entity level. It goes to you personally. So you're still, if there's profits based on if you're a sole owner or you have partners, the profits and losses are attributed to you personally, even if you leave the money in the company. So why that's good is that if you form a corporation, if you have profits for that corporation, those profits are taxed at the corporate level. And then if you then take that, so that you pay taxes on that end, and then if you take that money out for yourself, then you would have personal income tax on that profits, or taxed on dividends, right? So it could be different. Essentially, you're being taxed twice. So if you are thinking that your company is going to be a high growth startup, where, as you know, a lot of those companies lose money a lot for the first however many years they are in existence. A lot of those companies choose to be corporations, and C corporations in particular, because they're not concerned about that taxation issue because there's no profits. They're going to lose money for a long period of time. And then when you get to be a bigger business, having a corporate structure is preferable for a number of reasons, because investors, if you're thinking, okay, this is a high growth startup, I want this to be a $100 million company at some point, and I'm going to have lots of venture capital investors or other investors. Those types of investors, they prefer to put their money into a C corp for a number of reasons, some of which relate to their own personal tax considerations, which we don't need to get into. But they're also just more comfortable with the corporate structure, where there's a lot more precedent about how corporations are run and how they're treated by the state and the corporation code and so forth. And it gives them some comfort in terms of how the business is going to be run. Whereas an LLC, going back to the LLC, that's more of just, you can run an LLC however you want. You can have an agreement that says how it's going to be run. You don't have to have board of directors. You don't have to have meetings every year, board director and shareholder meetings and so forth. So there's greater flexibility, but also, just less familiarity, I guess, if you're just an investor that wants to passively put money into a company and and know that there are certain protections and it's going to be run a certain way. So that's where you would need to think about, okay, what type of business is this? Is this a side business, or and if there's losses, I want to be able to offset that against my personal income, or is this like a high growth type of business which is probably going to lose money for a while, so I'm not worried about that sort of personal tax stuff, and I just want it to be set up for the best way for investors to come in later. The S corporation is kind of an in-between between the C corp and the LLC. It actually gives you some of the advantages of the LLC in terms of not being taxed at the corporate level. You're only taxed once. And actually, it does allow you to if you want to pay yourself a salary, then the S corporation structure is good, because it actually allows you to do that. And then there's different advantages, which we don't need to get into, but in terms of your personal tax situation, if you have part of your income is employment income and part of it is distributions from the company, then there's ways to reduce your taxes doing that. But again, that's not really that's more of an accounting question. So a lot of these situations are unique to you and whatever other jobs you have and so forth. So there are considerations that you want to talk to someone who knows about, who does this, who's an accountant, in terms of, okay, hey, what's the best structure for me? And here are my other businesses that I have, and here are my other jobs that I have, and personal assets. So they can sort of take that and come up with the best structure. But this is just kind of an overview of your options. So most small businesses choose the LLC or the S corp structure, though. That's just tends to be the best. The next, so if you've decided, okay, I want to do an LLC, I want to do a corporation, question you need to decide after that is where you want to form that entity. Most people form their company in the state that they're doing business in. Obviously, that's changed somewhat as people do more of their business online, but still, it's just wherever you're working, you're going to have to file something in that state. So if you say you live in Detroit, for example, and you say, well, I heard everyone does Delaware corporations and those are the most friendly for investors and businesses and so forth, then you would create your company in Delaware, but then you would also still have to file something in Michigan and pay the yearly taxes for having a company in Michigan. So when you're starting out and those costs are not insignificant, a lot of people just say, well, I'm just going to form the company in the state that I live in, which is fine. But and so this gets to the question also of what type of business you're creating. If you're creating, like I said, a high growth startup, where you're going to have investors coming in, investors prefer, traditionally people say Delaware, which is still true, because it's very business friendly. It's very easy to make filings there. It's very established corporate law, so people know how minority shareholders are treated, for example, or what the fiduciary duties of the board members are, like things like that investors care about. Reasons why people like Delaware, for example. But in California, just because there's a lot of startups in California, right? There's a lot of small, people starting business in California, so California is also a popular place, but it's actually not very business friendly. So a lot of people in California might form a Delaware corporation and then register it in California. So again, it does add additional cost, and it just gets to what type of company you're starting. There's other business friendly states too that people use. I know Nevada is popular. I mean, there's states that want people to form their businesses there, so they try to make it as easy as possible. And so there might be a state closer to you that people use a lot, but just keep in mind that you will still have to file something in your state. Something that again would be out of my jurisdiction, but just something to keep in mind, because if you're selling online, you're obviously shipping to wherever people will buy your product. and the laws have changed because a lot of states are realizing that they want to capture sales tax for the people in their state that are buying stuff online. I think for the most part, it's only going to be after you have a certain amount of revenue in a state where they're going to care. Maybe 100,000 in a particular state or something like that. So it's worth checking as you get bigger. I know, for example, in California, like when you're a business in California and you sell this one in California online, you still have to collect sales tax and pay sales tax. The question is really like if you're just selling to somebody in some state where you have no connection, if you have to pay sales tax there. So it's not if you're just starting, it's not a huge issue. But as you get bigger, then something just to keep an eye on. And again, you can talk to a tax person about that. Something else to consider is just local, city, state, county requirements. If you're doing business in a different name than you create a company as, or if you're doing a sole proprietorship and you still came up with a name for your business, you are supposed to make local filings. Like in LA, for example, it's a very sort of outdated process where you have to apply to register the name and then pay some old newspaper that and they have a section in the back where they publish all of the doing business as names. So it's just this sort of outdated process. But typically, like if it's you always want to protect the name you've come up with, and obviously creating an entity helps you do that. Somehow, if you're not ready to create an entity, then having a doing business as name does give you some protection too. And you'll notice that if you apply for like licenses, and depending on what type of business you're in, then they obviously want to know. If you say that, oh, my name of my business is X, they obviously want evidence for that. And if you haven't formed a company, then you would at a minimum have to provide them evidence that you registered the name locally. So it's a sort of an annoying thing to do to have a DBA. So I would recommend also that if you have a name for your business, you use that name in the state filings where you're creating the S Corp or the C Corp or the LLC. Because if you create the entity in one name but are actually using another name, then you would have to separately register that name, which again is a pain. But if you're just using the name that you're incorporated as, then you typically don't have to do anything locally to register the name separately. So something also to keep in mind. So if you do get to the point where you have created an entity and you're wondering, okay, now how do I run my business as this entity? What do I do differently than what I've been doing before? The main reason, one of the main reasons to create an entity is it gives you personal liability protection. If somebody sues the company, they only can get what assets are in the company. They can't come after you and whatever other assets you have. But if you don't actually run your business that way, then you might not get the benefit of that separation. So like you have an entity, you created it, but you're still using your personal bank account to transact business, then technically the assets have been commingled and you could potentially they could be exposed, even though you created an entity. You're like, oh, I have protection, I created this entity. But if you're not actually using the entity and separating your personal assets and your whatever else you have going on from the business, then you could possibly still have exposure personally. So once you form the entity, if you're registering trademarks, even domain names, you want to make sure that you're putting those in the name of the entity. And if you've already done all that stuff as personally, and then you later created the entity, then it's it's not simple, but it's not that complicated to transfer that stuff over to the entity. If you registered a trademark, then you actually have to have a filing in the with the trademark office saying I'm assigning it to this entity. So you're looking at first of all, to file a trademark, you're probably looking at like $1,000 basically to do so, and to assign it would be even less expensive than that. But when you're doing that things again, you're trying to separate the business. Sorry, that's 1 second. Sorry. Sorry about that. Work from home world. But yeah, so basically, forming a bank account is a really important thing to do once you have an entity, to make sure that you have a separate bank account. Uh, when you sign contracts with vendors, clients, you should always try to use the name of the entity. And you sign as the president or as the partner, managing member. You should obtain a tax ID number, because again, you want to remove your personal identity from the business, other than as the CEO or the president of the company. If you're doing business with other people, this is really important. You each created a product, or you're each putting in work to this company. Whatever it is that you're creating, you want to make sure that it's clear that the business owns that entity. A lot of people don't do this because, okay, one person who's more involved in the sort of admin side is actually filing the trademark, and they file it in their name, and not in the business's name. And then later on, it can create an issue, right? Because that person actually owns the trademark technically, so not the company. So if you're doing software development stuff, this is really important too. Basically, you want an agreement amongst each of you that says, whatever we're creating here is going to be property of the company, and not, because the way that intellectual property laws are set up is basically that if somebody creates something, that they own it. So you need very clear language saying that this thing that we're developing is going to be owned by the company, not by the individual too. And also, if you are hiring outside developers too, that's also very important. Because again, even though you're like, oh, well, I hired them to do this, and obviously I own whatever they do, but unless you have an agreement that says that, then it can get very murky. Because, like I said, the laws favor the person that created it, even if they did it as a job. And especially if you are, you're often working with people that they may be overseas, they may be in different places. So, it'd be hard for you to enforce these agreements in different countries, but you still want them. It certainly protects you, at least, locally or in the U.S., in terms of if there's a dispute over who owns the product that was developed. So that's just the larger point, is separate your business, run everything through the business, keep your financial stuff within the business. And just touching more on this, sort of, it may not apply to some of you, but if you're in business with somebody else, not only should you transfer the IP or whatever you're developing to the business, but you should also just have an agreement between you as to what people's roles are, what their ownership interest is, what are some early milestones that you're shooting for, to sort of decide whether or not the business is being successful or not. Because almost all the time what happens is that one person is doing a lot more work than the other person. not all the time, but that is a very common scenario, right? And so you don't need to have a contract right away, but I would just sit down and come up with a bullet point list of, okay, you're doing, this is your responsibility and this is my responsibility, and we're 50%, 50-50 in this, or I'm doing more and I put up more money, so I'm 75%, you're 25%. If we bring on other people, let's allocate 10% that we can sort of divide amongst them. So there's different ways to do it, but what you don't want to run into is not having thought it through, because you're so focused on the idea and getting started and so forth, that you don't want to have to work this stuff out later on. Because if somebody leaves, if one of you sort of say, oh, I'm going to go back to my other job or whatever, if you had already agreed that they own part of the business, or it was sort of said but not really written down, then you can get into scenarios where your business is doing well, you're running this business, but this person that you sort of worked with this to begin is lurking out there as somebody that potentially is going to say, hey, I own part of this business. And maybe they do if they actually, there was an agreement saying that that was the case. But um, especially if you're looking to bring on investors, that makes them very nervous later on. If you're saying, oh yeah, also just so you know, there's this guy or this girl that I worked with earlier on, and they might come back and say that they own this part of the business, and it's unclear, that can reflect poorly and make people nervous about investing into your business as well. Um, so define roles, define ownership interests. And just one thing to point out is that even though one person might be putting up more money to begin with, if it's not a large amount, I wouldn't use that as the sole basis for determining who owns the company, right? Because if you're working 12 hours a day on this company and they just put up $10,000, your sweat equity is much more valuable than that $10,000, especially if they're not helping out. So that's not the only way to base, who owns, what percentage of the business. And this is a very common scenario, is that, you're probably putting money into your company just to get it started, to buy products, set up your store, advertising, whatever. It's good to think about how that money is going into your company. Are you loaning it to the company? This is again assuming that you've sort of separated out the business. Is this like an investment that you'll have in the business that you'll hope will grow and you'll recoup? There's not a right answer, I guess, but just keep track of all the money that you're putting in for sure. Not only just for your personal like tax situation, but you want to know that, okay, I invested $100,000 or $50,000 or $10,000 into this company over the last year, because you will, if you have a separate business, I mean, you don't necessarily just, that money's not necessarily just gone, right? If the company starts to do well, you can then maybe pay that money back. But the sooner you start keeping track of it and sort of defining how it is that you're putting money into the company, the better, the more organized you'll be, and the easier when you go to an accountant and say, like, what's the best way how should I handle this? And he'll say, oh, you should treat this as a loan to the business or a capital investment. Then you'll have the most evidence of like able to track all the money that you put in. Again, if you are going into business with other people, something else to think about is that, I mean, people like to throw around like, okay, you own 60%, I own 40%. The way you can do it is that we both have to earn that equity, right, over time, because we're starting this business now. If you decide tomorrow that you're going to leave, then I don't want you owning 40% of the business. So the way that lawyers structure this, and this can get it seems like it's complicated. It's actually not that complicated, but it involves a lot of paperwork and definitely some like expense on the legal side. But what you say is that, okay, I own 60%, but I'm going to earn that 60% over a 4-year period, right? So each year, and then maybe each month after that, I own a little bit more, right? So a little bit more of that stock is mine. And so even if I were to leave after that point, I would not own the full amount, but I would own the portion of it that I've earned, however you decide to measure that. So, we don't need to we can get into that if you want to about how to structure that, but it's just an idea of when you're sitting down with your partner to discuss like who owns what. Just know that there's a way to do it where you're each earning that equity over time, not all at once. So that is the presentation, the slides I thought were the key considerations. Just to sum up, I think the main thing is really deciding what type of business you're building. Doesn't mean you can't change, obviously if you start a side business and becomes this wildly successful company, you can change your intentions, at that time. But if like, okay, I want to raise money for this company. I want this to be like a high growth startup where I'm going to put everything into it over 1 or 2 years, and hopefully it takes off. Then again, you're like, okay, maybe you should form a C corp, or some of the other things we talked about too. Or if you're like, okay, I just want to if you're just starting a store and you just want to see how it goes, then maybe an LLC or an S corp is better, or even just taking some risk and saying, okay, I'm just gonna have it in my personal name for now, and because the exposure is low because I'm not doing that much business. So really, you have to decide where you are at in the life cycle of your business. And again, don't in getting advice on these types of things, like everybody's situation is different, and people don't, like someone who's a founder, business person, they sort of remember how they did stuff, but I wouldn't just rely on, even if they're experienced, I wouldn't just rely on their advice in terms of how you should go about it, because they may not be remembering, because this isn't what they do. This is just something that they did along the way, the legal or accounting type of stuff. So, when you're really getting into the nuts and bolts, you want to talk to somebody who does it for a living. And just to sort of emphasize that, the sooner you start treating your business like a real business, like a company, other people will sort of treat it that way as well, right? Like if you're entering into a contract with a vendor, if it's you signing the contract personally, they're like, okay, this must be somebody just doing this as a side gig, and then maybe they're slowing down your order, or they're not prioritizing it, but there is something to be said for having a company name. Like sometimes when you call, I remember this when I had my business, when you call vendors and stuff, they're like, oh, what's the name of your company? And if you're like, oh, it's just me, I'm doing this on my own, they might be like, oh, okay, like this isn't somebody that's going to be a big customer. But if you're like, oh, my company is X, and you're signing the contract as X, you might find that they treat you like more professionally. So there's just soft advantages to doing this, but there's also certainly real protection for you, and certainly at some point, if the business grows, you want to make sure that you're separating assets and forming an entity, and having agreements with your partners and so forth. So this is just again my background. If you want to get in touch with me, email, write down my phone number. If you want to text me, that's fine as well. If you have questions about any of this stuff, people sometimes wonder, if I'm in this state, can I only work with lawyers in that state? And sometimes it's easier, especially if you're in Indiana and you want to form an Indiana company, then it's oftentimes easier to hire a local attorney, or but if your business is a little bit more on the high growth side, or you just want more contract advice about some more sophisticated contracts, then just finding the right lawyer that you like working with is more important than necessarily having them down the street, I guess. So I don't know how we're doing on time, so forth, but if people want to ask questions too, then I can definitely
we have time. Thank you, Brian, for that. That's quite amazing stuff. It's really, really important. I mean, I know you pitched that to me, preached it to me, that you got to do this. You got to, and I always in the back of my mind now that I do things. I have that, and I'm still going to do things with you, but I just haven't. I haven't had anything worthwhile to do anything yet with you. So, but it's coming shortly. So I will.
Yeah, no, I mean that's the reality, is that it takes time to get these things off the ground. So like I said, so even forming a company, you're looking at a couple $1,000, right? So it's not something that people are excited about spending money on.
Yeah, but it saves you in the long run. I mean,
totally.
honestly, it's just like, it's the penny wise, pound foolish, kind of stuff. That's the whole adage that it looks expensive in the front, but you know what? In the rear view, when you look, you're like, oh, that $2,000 it could have saved me $50,000 in legal things, right? Yeah. So it's always that. It's you don't look in the rear mirror, or you never look forward. You always look back, and so it's just
the other question I get a lot is, can I use LegalZoom or just do it myself, kind of. Right. And the answer is there's not necessarily a right answer, but the answer is that's those companies, and their forms are fine. If you use them, I think down and your business grows down the road, you'll look back and you'll be like, okay, these are not the best legal documents. Right. But if you just want the minimum liability protection, I just don't want to get sued, I just want to form a company. Right. It's fine.
Right.
You can use them.
Yeah, I think it's just been in the mindset of how you're going to go about it, but also, being able to get some legal advice, tax wise, best way to do this, things like that. You're not getting with that with LegalZoom. You're just getting a document to fill it, to do it. People, I mean, when I first set up our thing, we did it in Wyoming because it was tax free. You're like, oh yeah, we don't have to pay taxes. But that's not the truth, because you're in California, you have to end up paying taxes. It's the nexus stuff. It's really gets you, right? So
Yeah.
it's not like you can, if you go to live in Nevada, sure, you don't have to pay taxes, but right now, what are you going to do? so,
Yeah.
so I mean, I guess if you fly under the radar and you only have like $1,000 worth of sales, nobody's going to say anything,
Right.
but I mean, as you get up to 10,000, 20, 50, 100,000, 200, you know, there's going to be tax consequences. So,
Yeah. I mean,
um,
especially like Amazon too. Like, I mean,
right,
if you start doing a volume on Amazon, I think
right.
um,
Yeah.
there's just risk also of people knocking off your stuff or just having disputes with other sellers too. So like, the more you
Right.
have your ducks in a row,
Yeah, 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 yeah,
the
for
better.
sure. For sure. So let me open this up. You can unmute yourselves, ask Brian questions, and we'll keep it going for a little bit.
So, as a entrepreneur within the apparel area, what was your, and being a lawyer, what was your biggest legal concern as you were building out your business and as you were running it?
Oh, good question. So I was always concerned about because I was working with factories in California.
Okay.
And so I was always worried that there would be some issue at the factory that I was working with, right? And so in California, um, it's just a hard place to do any kind of business, but also particularly highly regulated businesses like apparel. So basically, if the labor division, whatever, came in and had a raid on a factory, um, they could look at me as a person. Okay, when you had these people that were working, if they weren't being paid properly, overtime, whatever, um, California could come in and say, well, you were working on this project for Brian's business while you weren't being paid overtime. So I can go to Brian and say you are actually liable, for this, the failure of the factory. I mean, I had no
Right.
idea. I had no idea if they were paying them properly. And you could go in and sort of inspect the factory and say, yeah, it looks like a legit place. But I mean, the reality is I had no idea, if they were working like 23 hours a day, and treating people horribly. So, I mean, that was my biggest concern. But again, so what you do is, so again, like having the protection of your entities, I was always very careful. Like, okay, anytime I, especially did business with the factory, I always did it in the company's name. And I actually had to get a license in California, which was super annoying because I wasn't actually sewing the clothes, right? I was just contracting out. But
Right.
because California is California, they need me to get a license. And that was one of those things. It's like I know, and again, if I didn't have a legal background, I probably just wouldn't have got the license, right? It's just was such a waste of money. I had to go take a test, and it was so annoying, and expensive. But and I know companies that are actually doing like maybe like $1 million a year or something. They still haven't done it because it's such a burdensome requirement, and also they're just sort of they started out and they say, well, we're just gonna take the risk, right? And then at some point, you have to, if you want to do it properly, you have to acknowledge to them that you've been disregarding it up to that point. So you run the risk of them saying you owe us back, licensing fees for the last
Oh,
5 years, essentially. So
right.
that's just something to be, if you're kind of under the radar, like Andrew said, and all of a sudden your business gets bigger, and all of a sudden you're not under the radar. And then it's like, well, you've been in business since 2010. What's been going on since then? And you run the risk of being sort of penalized with interest, on by the local officials or state officials or IRS or something. So
Right.
something to keep in mind.
So I have a question.
Sure.
Can you hear me? Okay. So if someone was starting, let's say a Shopify business right now, as a new company, would you suggest, you start, he just do a Delaware corporation, or just or just do it at the state where he lives? What is the pros and cons?
Yeah, it's a great question. I mean, there's the pros are it's very easy to form a company in Delaware, just in terms of using their Secretary of State website. It's just easier to figure out the business, like the corporation's code in Delaware is very business friendly. So if you're looking down the road and you're going to have smaller minority investors, they're going to have more rights in a state like California, right? To say that you're not treating them rightly, or that, okay, you took some action as a board member you entered into business with a friend of yours or your friend's company, and your 2% owner is saying that you should have come to them, to get their approval, so forth. So there's more rights in states like California for people that are smaller investors. California is like the extreme example. Other states are sort of in between, but you'll just find also that some states that don't have a ton of businesses in them, they're just not as sophisticated in their sort of legal forms. It's hard to work with them in terms of getting stuff filed. So there's just a practical element too, but I gotta go back to sort of what type of business are you building, right? So for most people, for a small business, it makes sense to file in your jurisdiction. But if you are looking to attract investors down the road, Delaware is something that most people are very comfortable with.
Okay, thanks. So I just basically even so, let's say California is not very business friendly. It's still okay to form a corporation in that jurisdiction, in the long run, right?
Yeah, absolutely. I mean, that's what I almost recommend if you're in California and you're just not sure like how big of a company this is going to be, because it's significant. So, for example, if you form in Delaware, you're going to pay them like $800 in just your annual franchise tax, basically. Then you're going to also pay $800 to California. That's not like based on your revenue. That's just like the annual tax to have your company there. Okay, so that's like.
So you pay twice, one to the Delaware and one California. Oh,
yeah.
Okay.
Yeah, because Delaware is saying, okay, you want to be a Delaware company? Okay, pay us. And California is saying, well, you want to do business in California? We'll pay us. So again, so all these things that where if you're doing millions of dollars in sales are not significant, but if you're just getting started, they are significant, and also you're going to, in theory, probably pay somebody to form it in Delaware and also do the paperwork in California. So incremental at the beginning, it feels like a lot, but if you really are of the mindset of, okay, I'm going to be raising money soon, and people, the investors I'm looking at are going to be more comfortable with Delaware, then it's worth it to do it. You can change your mind, right? So say you form a California corporation and you just find it super annoying, you can convert into a Delaware corporation, but it's a bit of a hassle. You're probably looking to spend a couple $1,000 to do so, and at some point, if you have a lot of contracts that say you're a California corporation and so forth, it can get a little tricky, but it is possible to do. So if you say, well, I thought this would be a small company, but it took off, and now I'm looking at these investors, but they want me to be a Delaware corp, you can change later on. So it's not like a permanent decision. It just gets, the bigger you get, the more complicated it gets to do so.
Thanks.
Sure.
I had a question.
Sure.
Well, I'm in California, and my husband works in the gardening, and he's always wanted to start his own business, but I've always been afraid, you have to have insurance, just in case a worker falls, has an accident, or anything like that. And especially since there are people who actually sell, like if a gardener does 10 houses a week, they'll whatever that price is that they charge for the house, they'll charge it 3 times. And how would you, like, if you were to buy something like that, how do you try, like, what type of business would you put it under?
Okay. So basically, there's gardeners that are looking to sell their business at
Yeah.
this 3 times rate. Okay. I think you probably want to do a either an S corp or a limited liability company.
Okay.
And my guess is a lot of people don't. They just run it as a sole proprietorship. But like I said, you do have more exposure there for, like you said, workers. Because I think in California, once you have one employee, basically, you're supposed to have workers' compensation insurance. So some people say, well, I'll rely on the insurance, right, to protect me.
Especially because a lot of these businesses are like really under the table.
Right.
They, so I'm always afraid of that, because I don't know, just you have a business, like, okay, somebody's helping you out, but what if they're cutting a palm tree and, like, I don't know, they fall off, right? So
Yeah, no, I mean, there's definitely exposure there. You would need to
especially
have,
like since you were to buy it, like let's say you would buy it off from someone who doesn't even have it registered as a business,
right.
you would just have to register it like under as
Well,
a
I mean, basically, like, I don't know what you'd be, if they'd be literally like selling you their company, or they would just sort of be like, okay, now these people now work for you, kind of thing, right? So
yeah.
if it's the latter, then yeah. And if you're worried about that stuff, then definitely it's better to set up like a limited liability company or an S corporation. Um, and then you'd have to require the sort of documentation from each of your workers, right? And then you have to get workers' comp insurance. Then you have to get like commercial liability insurance. So like, the homeowner is not going to sue you, right, for something you did
Yeah.
or because you destroyed something. So it just, and when you start going down that road, you realize, okay, this is not an insignificant amount of money and so forth. That's why people would just say, well, I'll just take the risk, right? And then so that's the problem. Is that once you go down this road of like, I want to do things the right way, whether it's the state or whoever, they make it expensive for you to do that. But if you do want that protection, that's what you have to do, and then
because I mean, even if you were to be doing this under the table and someone gets hurt, I mean, if you're doing your taxes like you're doing like independent worker, something happens, they can still sue you, right? Even if you're not,
I mean, you might have insurance that would give you some protection, but yeah, they would sue you. And then if the business didn't have any money in it yet, they could, in theory, come after your other assets, right? So so for sure there's risk if you're doing it on your own.
It just requires a lot of money, which is why we've always been kind of thinking about it, because we want to do this the right way. So it gets like really pricey.
But I mean, it's you'll sleep at night, and just doing it the right way. Also, like I said, it just also makes your business seem more professional too, right? So if you're going to someone's house or whoever looking to pitch them the business, it's like, okay, this is the name of our company. It has like such and such LLC. It just sounds better than like, Tom Smith, right? Or it's like, okay, this is such and such LLC, and here's our, license number. Here's our workers' comp, just evidence that, and you can pay checks directly into the company versus like, oh, we have to pay us cash, right? And so things like that just makes people comfortable and also allows you to charge them more. You say, look, we're a legitimate business. so we actually pay taxes and we do these things, so we have to charge you, $20 more or whatever that rate is, so. And people will say, well, if it's worth it to me, because they also have that same concern that you do, right? They want to do
Yeah.
business with a legit business, and they might be willing to pay more, right, to do that.
Yeah. Thank you.
Sure.
I have a question here. There's a company called Melissa and the Dog LLC, and their revenue is around 500 million. So I would like to know why they don't form like a corp. They want to choose LLC. What's the benefit of that?
Yeah, that's a great question. I mean, there's lots of large companies that are limited liability companies. There's nothing you can't do with an LLC. So I don't know what their particular situation is, but they may have wanted the flexibility of the LLC governance, right? So like I mentioned, like a limited liability company, you don't have to have the structured board meetings like you do with a corporation. There's more flexibility on not only corporate governance, but also like distributions of profits. They may have like some complicated tax considerations with one of their partners where it's better for them. Like if you see like sometimes celebrities like investing into companies, they prefer an LLC because of all the other business stuff they have going on, and it's like very complicated. They have this whole structure that they're expensive accountants set up for them. So there might be particular reasons some of their investors liked it, but they also might have just started as an LLC and because they preferred that early on, and then as they got bigger, nobody forced them to change it, right? Because there's some things are definitely harder with an LLC for sure. Like for example, like a company that size, they may have like a stock type plan for employees. So like you can do that for an LLC, but it's very complicated. Whereas if you do a corporation, you can there's just more of a set way that people issue options, and also employees are familiar. They're like, okay, I have an option in the company. And LLCs, you have to call them something different, and then you have to structure it more, in a way that requires more like tax planning and so forth. So LLCs are much more flexible though in terms of governance. So there's a lot of advantages to doing it that way. They might have particular concerns of or particular favorable treatment of certain partners. It might be a joint venture between two other companies, right? That's a lot of times people use LLCs to do that because again, there's so much flexibility in how you set it up. So yeah, so there's if you decide to do an LLC, you're not saying, oh, I'll never be a big company or I can't make this a big company. It's just that some investors prefer the corporation, or a lot of investors prefer the corporation, and you're trading off some flexibility in governance with some restrictions on things like options and so forth. Is that helpful?
Yes, thank you.
Okay.
Awesome. If somebody has one last question, we can ask it. Otherwise, it's at about 1 o'clock, and I know be cognizant of Brian's time that he's given. He's probably got to help others. So is there any last question, or we all good here? Okay. So, hey, Brian, thanks so much for coming on.
Yeah.
Super helpful information. I'm going to stop recording right now.